Understanding tokenomics is one of the most important things you need to do as a trader and investor in the crypto space. I see a lot of times people don't actually take the time to look at the tokenomics or understand how these different numbers can impact price as well as your strategy. So in this video, I'm going to go over everything you need to know, as well as give you guys an example of the ZK Sync airdrop, as well as tokenomics that were just released recently. Now, what exactly are tokenomics? Tokenomics are the economy of a crypto token. This decides how many tokens are going to start off in the initial circulating supply or distribution, how much total supply of this token is going to be, where these allocations are going to go. Is it going to go 30% to the team? Is it going to go 20% to the ecosystem? It also dictates the token emission schedule, or when these different tokens are unlocking, how much new inflation is happening and how long that inflation is going to occur. And I'll also go over the utility of the token you're actually buying. Now, what's really cool about tokenomics is this is how we can actually calculate the starting market cap as well as the fully diluted value of a project. And these starting distributions and emission schedules can actually have a huge impact on the price of the token and the time frame that we actually want to hold these different investments. And hopefully by the end of this video, I hope that you understand how tokenomics works enough so that you can personally plan your buy and sell strategies. Now, why exactly do tokenomics matter? Well, number one, bad tokenomics can kill even a really great project. As more tokens release what they call emissions, you will have continual sell pressure on that token. So for example, guys, let's say a new token comes out and only 10% of the supply is going to start off circulating. That means that there's going to be 10 times the amount of supply over a given time frame. And I saw this recently with Tap Protocol, where only 10% of all their total supply tokens were circulating day one, and the rest of the tokens are going to be out over the course of 1 year. So that means if you're buying today, there are now going to be, after 1 year, 10 times the amount of tokens. So unless there's 10 times the amount of demand, most likely you are going to lose money because as new supply comes in, it devalues the current supply that is already out there. Another major point is unless it's some sort of meme coin, usually these tokens release over time, and how these different distributions are happening can also have a huge impact on the actual sell pressure of the token. So seeing that in the tokenomics is going to help you make a better strategy. The tokenomics also dictate the starting market cap in FDV, and this can help you identify whether or not you think a token is overvalued or undervalued, especially before they do their sale. The next major point here is by knowing where these tokens are being allocated and how many tokens different individuals or teams are getting, you can have a better idea of the sell pressure. If you know there's going to be a major token unlock where a bunch of VCs are going to get a bunch of tokens and you know their main objective is to make their money back on their investment, then you can expect there's going to be more sell pressure from that rather than something that is more community incentive aligned, at least most of the time. And then the last major thing that you need to check on tokenomics is whether or not they establish a utility for the token that directly correlates to the project's success. You might have some sort of awesome dApp or platform or product and they'll release a token, but that token doesn't actually benefit from the project actually doing well. A lot of times I like to see if they do a buyback and burn with a percentage of their revenue or something like that. So then that way you know, hey, as they make more revenue, there's going to be more buy pressure on their token. I've seen a lot of times where the token is simply governance and you actually can't do anything with it. Here's the list of some of the different names and what they mean as you're going over these different tokenomics. Circulating market cap is simply taking the current supply that's circulating and multiplying by the current price. FDV is when you take the total supply, even things that aren't circulating, and you multiply by current price. You then have initial circulating market cap. That's how much of the supply is going to be released on their TGE, which is their token generation event. This is how many tokens are going to be circulating day one. And total supply is the total amount of tokens that will exist for this specific project. And a lot of times you can't actually change it. If you hear the word cliff, that means that the tokens are locked for that amount of time. So you'll commonly see a 6-month cliff or a 1-year cliff. This means that all of those tokens that are allocated to that specific allocation are not not going to be unlocked at all until that cliff ends. Then you'll commonly see vest, which means how many tokens are going to be emitted over a specific time period. So for example, if I say it's a 10-month linear vest and I have 100,000 tokens, that means each of these 10 months is going to emit or release 10,000 tokens. If I say it's a 6-month cliff and then a 10-month vest, that means for the first 6 months, I get no tokens at all. And then for the next 10 months, I'm constantly getting 10,000 tokens or 10% of my allocation. If you ever see VC or seed, it means that they were early investors or venture capitalists, accredited investors, that sort of thing. If you see foundation or assembly, it usually means that these allocations are voted on by the community or by some sort of foundation within a project. You then have team, which is the team of the project, advisors, those who give advice to the project. I view this as a team allocation. You then have ecosystem, which are generally incentives given for participation, such as having some sort of points program where the more you use the DApp, you're able to earn their token. They'll then have a public sale in a lot of situations, which are tokens that are available to purchase from anyone. A lot of projects have been doing airdrops, which are free tokens that are given out based on specific parameters of engagement or participation. You'll then see development sometimes. These are tokens that are allocated to help fund the development of the project. Once again, I view this as a team allocation. They'll also sometimes say marketing, which is used to market the project. Once again, I view this as a team allocation. And then the final thing here is liquidity. How many tokens are actually going to get paired with liquidity for a decentralized exchange, as well as additional tokens available to give to centralized exchanges for them to trade that token. Ideally, when it comes to the liquidity, they are locking that liquidity, which means that they can't remove it at any time. And if they do remove it at any time, you'll no longer be able to trade that pair. Now, what do I personally look for? Well, depending on the structure of their tokenomics as well as their sale details, it helps me define when I want to enter and when I want to exit, as well as if I want to participate in the sale in general. So just to give you guys a couple examples, and then I'll go over the ZK Sync tokenomics. If I believe that the starting circulating market cap is lower than the market value, I will participate in the sale. So for example, guys, if they price the token at a rate where the starting circulating market cap is, let's say, $10 million, and I compare that project to other similar projects in the space, and I notice that all these other projects have around a $40 million market cap, I can expect that there's a chance that this sale is actually going to do well and that I might be able to make a quick flip on it. The opposite is also true for these points I'm going to bring up, where if the starting market cap is high compared to other projects in the market, then I most likely wouldn't participate in the sale. Another thing I look for is if the starting initial supply is very low, then I know there will be a lot of token emissions, which is usually bad for a longer term hold. So I can see an amazing project come out, such as Tap Protocol, for example, but only 10% of their tokens are going to start right away. And I know over the course of a year, there's going to be 100% of the tokens releasing, which means there's going to be 10 times the amount of tokens over the course of a year. So in my opinion, I would rather wait until a lot of those emissions are done and then get in the future. But because this initial supply percentage is so low, you know you're really going to have a lot of sell pressure and a lot of dilution over a period of time. And typically those are not investments you want to hold. Another point is if there is a high allocation to the team or VC, this can be a red flag for me. A lot of these new projects coming out, they kind of scapegoat and they get like 30 to 50% of the supply by saying, oh, we have a development, and oh, we have marketing, and oh, we have advisors, and then we have team. And it's like, okay, this is all a team allocation. And whenever they have way too much of the supply, they're really going to have a huge impact on the price. Yes, it's okay for them to have an incentive to work on the project, but when they're giving themselves a ton of tokens, this is a red flag for me. I also like to see if they have some sort of cliff, which means their tokens are locked, or how long their actual vesting schedule is, and that'll give me a better idea of when I want to sell. Because for example, if I know there's a massive unlock happening where 20% of tokens are releasing and they're all going to VCs, I know I probably don't want to be holding the token at that period of time. Another thing I like to look for is if that token utility is based on the platform success. Once again, just because it's a good platform platform doesn't mean that the utility is good itself. Another thing is if the initial supply is high, let's say above 50% or above 60%, I may be more likely to actually hold that token for the long term as long as the FDV is reasonable. And this is because the amount of new emissions coming in is going to be relatively insignificant compared to other projects out there. And it makes the proposition of actually holding this token for the long term make more sense. And then the very last note is the initial starting distributions being fair or being even. I see sometimes with these initial starting distributions that there might be a few people that got way too much of the token, especially if they sniped the token or they did some sort of airdrop and the airdrop had a bad distribution to it. Whatever the case is, I pay very close attention to this. You want as many people to have as even as a distribution as possible. And the more people that have a large percentage of the supply, the worse it is because the more damage they can cause to the actual price of the token. Now let's look at a breakdown of ZK Sync's tokenomics, which they just released recently. So first part is they have 21 billion total tokens in supply, and they'll always have their token address as well. So you can verify that you're buying the correct token. Then for their allocations, it's always out of 100%. They're saying 16% is going to their team, 17% is going to investors, which is that seed and VCs, 17.5% is going for a free airdrop for people that were interacting in their ecosystem. Then you have an additional 20%, which is going to incentivize the ecosystem further so people can keep using their platform. And then they're saying 29% is going to token assembly. This is another word for foundation. And a lot of times these tokens are voted on of how they actually want to be used. This user then breaks down the airdrop distribution, which is great. A lot of this starting circulating supply is going to be that airdrop. So you want to make sure that this airdrop was actually well distributed. It's saying around 89% were ZK Sync direct users. You then have some people that were native to ZK Sync, some on-chain communities, developers, blah, 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 blah. But the big point is there were 695,000 whitelisted wallets, which means wallets that were able to claim this airdrop. So you have a very large pool of holders that are starting off with this token. A lot of times they'll also have a pie chart where you can pretty easily see where these different tokens are being distributed. As far as ZK Sync, this doesn't look too bad. This airdrop percentage was actually very high and rewarded a lot of people that were interacting within the ecosystem. For them to have 33% going towards their team and investors isn't too bad of a percentage either. A lot of them have been going 40 to 60%, but this is about as high as ideally I would like to go. Then with this 29.3% towards the token assembly, I believe that these are going to be voted on with how the community wants to use those funds. And I think this is pretty fair as well because the community is going to do whatever they think is best aligned for the price of the token. Now, what this post isn't showing is the actual token emissions and unlock schedules, which is really important to look at. I don't believe ZK Sync actually released their tokenomics emissions schedule, and that's something that you have to pay a lot of attention to when they do release it, because if there aren't a lot of cliffs or vests with these different team token allocations, they can really dump on the market very early on, and that can have a negative impact on the price. Now, typically they will have the full tokenomics released before they launch the token, so you just have to keep an eye on that. I did want to show another example of what you would potentially see though, just on another site where I'll say vested for a 12-month period. A lot of times they'll say linear vesting. A lot of times they'll say 6-month cliff and then 12-month linear. There's a lot of different things out there. And based on when those different token unlocks are coming out, you can determine when you want to exit your position. There's also a really great site called token.unlocks.app where you can actually see the next upcoming token unlocks and how much that's going to impact the price. So for example, I can click on something like StarkNet and I can see the different emissions that are going to happen over different time periods. They do have a payment wall on some of this information, but then you can see the actual current locked progress. Where StarkNet, for example, you can see that only 8.5% of the tokens are currently unlocked, with most of the tokens still being locked, which means a lot of emissions are going to come in. And the next unlock event is actually June 15th, which is tomorrow, where they're going to release another 4.92% of the actual circulating supply, or about $68 million worth of additional tokens of current market value. So it's really important to pay attention to these different token unlocks because, like I said, it can have a huge impact on the price. Now, you might be wondering, what numbers should I look for each allocation? And it's really hard to say, guys, because there isn't necessarily a right or wrong with a lot of these different tokenomics, but more so what you're looking for is what your entry and exit strategy is going to be based on the details that are presented. Okay, I know that the initial circulating supply is only going to be 8.5%. That means a lot of tokens are going to be coming out in the future, but I know there's going to be no more tokens coming out over the next 6 months. Well, that means that maybe this is going to pump like crazy in the beginning because there's going to be no new tokens over the course of 6 months. But then as soon as those tokens start coming in, I know that all of that sell pressure and all that dilution of my holdings is going to have an impact on price. I can look at something where a lot of the supply is already circulating. I can say, hey, this is something that's going to be a way better hold. I can look at the tokenomics and see that 60% of the supply is going to the team and VCs. I know right off the rip, this is not something I want to hold very long term because a lot of the supply is going to a very small amount of people that can have a huge impact on price. Hey, I see that the starting distribution has over 700,000 different holders. I have a pretty good idea here that this starting distribution is going to be pretty solid, and there aren't too many tokens being allocated to too small percentage of people. So over time, you'll get a better idea of how to actually use tokenomics to your advantage. And in the next video, I'm going to go over the token sales and how this can also have an impact on the price of the token. And I'll catch you guys on the next one.